giving people the tools that they want to use is what this space is all about. And so I'm a user choice maximalist. I think people should be able to use what they want, and we're happy to support them in whatever they choose.
Hey everyone, welcome to the Smart Economy Podcast, where we ask your favorite builders the questions you wish you could ask them yourself. This is a production of neonewstoday.com, and I'm your host, Dylan Grabowski. In this episode, we're joined by Sam MacPherson, the CEO of Phoenix Labs, an R&D group dedicated to building out the Spark protocol ecosystem. In today's conversation, we discussed the genesis of Maker and its transition into a DAO model, the rebrand of MakerDAO to Sky, stablecoins as crypto's killer use case, on-chain yield-bearing stablecoins, Spark as the largest on-chain capital allocator, the role of yield from real-world assets, helping to onboard the next 100x users, and so much more. Just a reminder, nothing said on this podcast is a solicitation to buy or sell any tokens, and that the guests or a host might hold tokens discussed in any given episode. You can check out a full disclaimer at www.neonewstoday.com. Also, if you enjoyed this episode, please rate and review it on your favorite podcasting platform and share it with your friends and family. Every rating, review, like, and comment helps us reach more people and bring you more of your favorite guests. With all that said, I really enjoyed speaking with Sam, and I hope you enjoy the conversation too. Hey everyone, welcome to the Smart Economy Podcast. Today we're joined by Sam MacPherson, the CEO of Phoenix Labs, an R&D group dedicated to building out the Spark protocol ecosystem. How are you doing today, Sam?
I'm doing great. Good to be here.
It was really fun to kind of delve into what you're working on with Spark. We were talking earlier that I'm based here in Colorado, and I remember years ago in 2019 going to community events where they were giving out DAI to onboard users into blockchain and show how stablecoins can be used to purchase things like beer at local events. So it's really cool to kind of be talking to someone who was once a part of that ecosystem and is still adjacent. But before we delve into what Spark is working on and your background in Sky, I'm curious to just hear a little bit more about your background because it's super interesting. You've got a variety of verticals. You were working, I don't even know what Motherson Sumi wiring is. You worked in the gaming space, and then you also worked at Sandbox. So before your intro into Sky, can you share what your background was and how you landed into working in the blockchain and crypto space?
I've been a software engineer for probably about 20 years now, basically all my life. And before the blockchain, I was a video game developer. So I worked on a small company. We didn't really release any big titles, but we were working on a startup. But then I kind of got sucked into the DeFi world, and I haven't really looked back since. So how I got started in the space, I think like most people, I joined in this 2017 ICO cycle. Just hobbyist investor. I was aware of Bitcoin for a while before that, but it was really the smart contracts that got me interested in the space as a software engineer. And so Ethereum was the first thing where I'm actually more deeply getting involved. And then I think most people do in the ICO cycle, they're just looking down the charts. They want to find some high upside stuff and that looks interesting. And so, in a sea of Dentacoin and all this craziness, I found Maker, and I'm there's a product, it makes sense. Stablecoin, there's cash flows. So me as a fund, a value investor, I gravitated towards this. And so just long time lurker on the forum there for a couple of years, just learning, digging into all the smart contracts and how this stuff works. And then I joined the protocol in an official capacity in May 2021. I joined the protocol engineering team. And this is actually the inception of the DAO taking over the reins from Maker Foundation. So up until about that point, the Maker Foundation was running the protocol. And then there was this transition phase to the DAO. So I never actually worked for the foundation. I came in, most of the other people actually came from the foundation. And then they joined in these, what we called core units. But I joined in from the community.
That's super cool. I actually got into the blockchain space as a token speculator as well in 2017. And it was largely because I'd like done all my research on index funds and 401ks and did everything I could to figure out what like traditional investments were. And then everybody kept calling Bitcoin a scam. So I was like, all right, why is it a scam? And I orange pilled myself. So it was a super cool time. I actually never got involved in Ethereum back then because CryptoKitties clogged the network and it was too expensive to use. And so the market was hungry for different blockchain networks that you could tokenize and launch ICOs on top of. We're in a completely different world from then, though. So were you building on Ethereum back then? Were you testing out smart contracts, or were you just purely from like an investor's perspective and just playing around in blockchain back then just by like acquiring tokens and checking out different networks?
Hobbyist investing was the first point of entry, but then learning how to do smart contracts. I started that in a serious way in 2020. So I started learning Solidity. I wrote a few of the contracts that actually went into production at Maker. I wrote a flash minting module. I think that was one of the first that I did, as well as the peg stability module, which it's actually been replaced about a year ago, but it was in production for quite a while, holding billions of USDC. Back in 2020, I built that as part of the community and then went into production. And I was like, this is the coolest thing ever. Seeing stuff that you build, then suddenly custodying billions of dollars, it's a little bit surreal. So I was pretty hooked on it from there on out.
What was mental gymnastics, I guess, would be the best way to put it, that you had to go, or maybe the mental hurdles of working for a DAO when you came from working from like a centralized entity? Was there like some psyching yourself up and talking yourself going to work in this crazy Web3 blockchain paradigm, or was it just like an opportunity that you were willing to jump at and being an employee of a DAO was just part of the game?
No, actually quite the opposite. I've been an entrepreneur all my life, so risk and doing unique things is in my blood. I'm quite comfortable in these types of situations. I've basically never had like a more traditional job. I've always had startups, with varying degrees of success over the years. So yeah, working in a DAO is just it wasn't that much of an adjustment. I'm very comfortable in a place where forging new territory, basically. So that's what's exciting to me.
Cool. Other than the projects that you just mentioned, that your contracts that were launched when you were at MakerDAO, your tenure was during the bearish market following post FTX. So what was just the mentality of what you were working on during that time? And what were just the vibes of being at a DAO during a bear market?
Actually, when we started, it was just at the start of the 2021 bull. So we went through a full bear cycle when I was at Protocol Engineering. And I mean, I must say I much prefer bear markets. The bull market stuff, as an engineer, you're just getting pulled in so many directions. We have to do this, we have to do this, we have to do this. It's like a breakneck speed thing. And although, I mean, obviously we never compromised on safety, it's just it can be kind of a stressful environment, especially with a lot of projects that were taking massive shortcuts and just being completely reckless, FTX, Terra Luna, this kind of stuff. So yeah, I felt that was super annoying personally. And then once it's all over, you're like, okay, now we can actually just build real long-term products that are sustainable and we have peace and quiet for a few years. So I much preferred the bear part of the cycle.
Yeah, I do too. I spend a lot of my time being a content creator on socials. And during bull runs, I always equate it to, if you probably might not be able to relate to this, but before I worked in crypto, I was working in an office job and we had cubicles. And I always equated it to having the cubicle by the water cooler, where everybody would just meet and talk and be loud and ruin your flow and your concentration. And during bull runs, that's what it's like. Everybody's chasing the shiny thing. You feel like an idiot for not chasing the shiny thing too. There's a new shiny thing the next day. So they do say bear markets are for builders. And I 100% agree. Are you noticing that there's a different appetite for stablecoins and stablecoin yields in the various different market cycles we have, or are the demands for stablecoins maturing beyond the bull bust cycles?
I think stablecoins are one of the strongest product market fit crypto has currently, and it's already proven itself in my books. Through the bull and bear cycles, you see stablecoin supply just going up and to the right. There's some small dips, but it's just up and up and up, because it's pretty clear. For people in third world countries who maybe don't have access to banking, they want to hold their money in store of value such as the US dollar, or international money transfers. I don't know how many listeners have done this themselves. It's crazy. Like it's just such a slow system. So for these use cases and, payments and stuff like that, I think stablecoins have already established themselves. So we're more sitting with USDSs on the on-chain yield-bearing side of things. So Tether and Circle are doing quite well with building the high liquidity portion of this, but we're aiming the yield-bearing USDS version of the USDS as the place where you can park your idle funds so you could be earning at least the risk-free rate. And sometimes during bull market conditions, you could be earning sometimes even double-digit percentage.
I understand that crypto is a global phenomena, but we're based in North America, and currently there's stablecoin legislation going through the US. Like it or not, the US can wreak havoc on the rest of the world for builders, or it can make it easier for builders to build. And so from your perspective on what Spark is working on, and maybe even if you can just wear your hat for the time that you were at MakerDAO, what does something like the Genius Act or the Stable Act going through American Congress mean for how you build? I'm not like an expert in the legislation or in the bills, but there is a part that is trying to ban yield-bearing stablecoins. And so what is, from your perspective, like how much weight does this actually have? Is it something you're holding your breath over? Will there still be a role for yield-bearing stablecoins if one of these bills goes through and is unfavorable to them?
First, I want to differentiate the different kinds of stablecoins. So this bill is aimed at fiat-backed stablecoins. So this is like your Circles and your Tether and stuff like that. Products like USDS are fundamentally on-chain products. They don't interface directly with the banking system. So just first and foremost, that legislation is aimed at those stablecoins. I've seen this banning of yield-bearing component. This is clearly introduced by the banking lobby because they want to keep the margins where they take advantage of depositors within traditional finance. So I like the general move towards embracing crypto, making sensible regulations. I think this is very good for the consumer, but I do not see banning forwarding yield to users as anything but just money grab by the banking lobby.
That's who we're here to replace, because centralized power can kind of be corrupted. Absolutely. If we look at like 2008 and financial crisis and the housing crisis, like that was spurred on by centralized financial institutions. So do you think that in 2025, we still have this appetite, desire for people to escape like the traditional system and chase something on chain like SUSDS? What's like the appetite for on-chain access to stablecoins versus custodial solutions like USDC or USDT? Are we starting to see an inflection point where more people are choosing to come on chain and leverage these decentralized stablecoin solutions, or are we still kind of like climbing that hill?
Definitely still climbing that hill. There's, as much as the industry is growing, we're still small in comparison to TradFi. But I view stablecoins as the black hole that's sucking up everything into DeFi, and we're just kind of at the start of it. So it all starts with the tokenization of the US dollar, which is these stablecoins are. And then with the rising interest rates, this is why you see the growth in this next adjacent thing, which is tokenized treasury bill products, things like BlackRock, Biddle, and others. Because of the high interest rate environment, this is precisely why these are just growing so quickly. But it's just going to continue to snowball and move down the risk curve. So tokenized corporate debt and eventually getting to private credit. All these things are eventually going to come on chain one by one. And so I'm a firm believer that everything will be tokenized in the long run just because of the massive efficiency improvements in blockchain technology. So for something like TradFi, it's incredibly clunky, like sending around, calling people and sending spreadsheets and stuff like that. It's just crazy. It's very old school. With the blockchain, you can send somebody any amount of money across the entire world within, you have just sort of basically just waiting for settlement on Ethereum or whatever blockchain you're on. So you're talking about like 15 to 20 minutes basically at most for settlement. So this sort of improvement in and of itself compared to TradFi, where you're talking about T+1, T+2, which means it takes days, and then it's not operating on the weekend. Like this is just so old school. And maybe you think, why does this matter? But these inefficiencies translate into friction on the economy. And so you kind of see this as just the economy being less productive, basically. So at crypto, I think this is something that's very clear what the path to solving this is. And I think it's inevitable at this stage.
I had a very frustrating experience this weekend where for some reason, out of nowhere, I was just locked out of my bank account and I couldn't go online to transact or to send money around. And they had to make me call customer service to give them my password, even though there's an online portal and I could have just accessed it from the same computer, from the same network that I'd accessed it for years prior. And that's just as a retail user. That's just as one Joe Schmo. I can only imagine the inefficiencies that arise at more of an institutional scale. So you mentioned BlackRock and you mentioned all these various different sort of verticals of tokenization. I'm curious to hear how you're looking at that in terms of which tokenized treasuries, which kind of tokenized privatized debt can be leveraged to earn yield on behalf of yield-bearing stablecoins. If you go to Spark's liquidity layer, and I know we're kind of getting ahead of, we're putting the horse in front of the cart here, but one of the largest allocated assets distributed is BlackRock's BUIDL fund, and it's the USDC in there. So what are the relationships with these new tokenized RWAs and how they can be leveraged by liquidity solutions like Spark?
As you mentioned, the Spark Liquidity Layer is the newest product that we've come out with. It just launched in November of last year, but already it's scaled up to $3.6 billion. And we are the largest on-chain capital allocator. And the basic idea there is that we have this capital to deploy, and we want to basically just have every opportunity available. And so historically, on-chain has been very isolated from other things such as exchanges or treasury bill products or other RWAs. And so the revenue that was being generated by MakerDAO at the time, now rebranded to Sky, was largely being driven by on-chain over-collateralized crypto lending. So this is lock up some Bitcoin or some ETH, and then you can take out a loan against that. This is how Maker was created. So I think maybe a lot of people are familiar with this. But as the space has matured, we just get all these new options available. And really, it's just been going faster and faster in the past few years in particular. So BlackRock BUIDL is a good example of this. This is the treasury bill yield. So instead of having funds parked in stablecoins earning nothing, you park it in BlackRock BUIDL, and then you can earn the treasury bill rate, which in TradFi terms, this is known as the risk-free rate. So it's the risk is essentially the same as holding cash. And so you might as well be getting this yield. It makes no sense not to be getting this yield, basically. So because of all these opportunities that are available, the Spark Liquidity Layer is able to deploy capital at the scale of billions of dollars into each of these and continuously look for where the best opportunity is and rebalance the portfolio, even on the next block in the blockchain. So we've been rapidly expanding this. We have support for 3 tokenized treasury bill products: BlackRock BUIDL, Superstate, USTB, and Centrifuge, Janus Henderson, JTRSY. So that's at the tokenized T-bill portion. There is Sparkland, which is, the bread and butter, this over-collateralized crypto lending. This is still the biggest revenue driver for Spark as a whole. So this is great, and it's a strong use case for DeFi. We've also onboarded Athena. So this gives access to centralized exchange funding rates. So this is people who are taking leverage on perpetual futures, these types of products with Bitcoin and ETH. And so there needs to be funding on the other side of that. So when people are taking high leverage, the funding rates go up quite high. And so we're able to deploy capital into that to not only allow people to take this leverage in the first place, but also it generates a very good return during bull market conditions. So we can tap into that way. And then more recently, we've also onboarded a product called Maple, SERP USDC. So this is primarily Bitcoin lending off-chain. So it's kind of the same thing that's being done on-chain in products like Sparkland, except this is being facilitated off-chain. But this same thing, people have their Bitcoin, they lock it up, and then they can take a loan. But this time it's in qualified custodian versus on-chain.
Super cool to hear about the products and partners you have. Maple and Centrifuge are former guests of the Smart Economy podcast. So it's nice to continue to expand our repertoire of on-chain builders and yield deliverers. Before we delve into the products and partnerships, let's just take like one quick step back. Let's talk about your role at Phoenix Labs and the relationship that the team has, well, I guess with Maker or Sky now.
A lot of names.
Let's just start there. What's Phoenix Labs and the relationship with Sky?
So maybe to provide some context on this list of names that you gave, I recognize it can be a little confusing at times. So previously, everything was under MakerDAO. So there was the DAO structure and then there's the protocol, these two separate things. So in addition to creating one of the first DeFi protocols, Maker was also trying out this DAO thing for real at scale. And so I don't think anybody ever expected the first iteration of DAOs to work perfectly. It was a good first attempt, but there was recognized pretty quickly there was not going to work to be able to govern a protocol at scale to have this token weighted vote on everything type structure. There was a proposal that passed called the endgame proposal, which would restructure things such that I think the best analogy is that Maker then now transitioned to the brand under Sky. So Sky is the new version of Maker. Would function more like a central bank in that it would not be making any decisions really on where to allocate funds, what growth initiatives to do. Instead, it would outsource that to these sub-DAOs, which are also called stars. And so Spark is one of these stars. And there are going to be multiple of these stars that are focused on different niches. With this structure, you get specialization. So Spark is focused, we're engineer-heavy team at Phoenix Labs. We can focus on a specifically Ethereum, EVM, L2 type space, and others that are maybe experts at things like Solana, SVM. There could be a separate team working on that. So in this structure, Sky can issue wholesale credit to these stars, such as Spark. We are able to borrow from Sky and then deploy it somewhere else. And then there'll be some spread on this. And then the net interest there is retained to Spark. So the relation is you can think of it like central bank, commercial bank. Although I don't want to say it's exactly like that, but I think it's a useful analogy.
Then just to make sure I understand, the way in which Spark is able to pay for itself to exist is by using the revenue that's generated from the assets that are borrowed from the Sky ecosystem and then deployed onto Spark Liquidity Layer, Spark Lend, things of this nature?
Yes, that's exactly right. And one of our main KPIs you can see on this data.spark.fi website is we have the APY there. So we have 3.6 billion deployed and it's earning 4.85%. And so the Spark Liquidity Layer's job to basically get as much possible APY on that capital as possible. This is the design of the system. It's one of the most advanced capital allocation systems that exists within DeFi, all for the purpose such that you can deposit into something like SUSDS or SUSDC, and you'll be earning this yield on your USDS. And you don't have to worry about all the complexities of DeFi. You just kind of set it and forget it and know that we're working on your behalf to deliver the best yield possible.
How is this 4.85% APY distributed? Is it distributed to Spark token holders? Is it distributed to just people who contribute various different stables to the liquidity layer?
So this is protocol revenue, but more or less you can think of it going mostly to holders. So the SUSDS yield right now is 4.5%, and we're able to generate slightly higher than that. And the market is picking up a little bit, but it's still relatively dead. We basically have this system in place that when the rates start going up everywhere, we're in prime position to basically just tap into all of that across all of the opportunities in DeFi, CeFi, and TradFi. So that yield will scale up as the market goes. And so you as a depositor, again, you don't have to worry about it. You don't have to worry about chasing yield or anything like that. We're doing that on your behalf.
If you could help me and the listeners correlate external markets that drive the interest rate or the market for stables, what would that be? For instance, if you look at high levels of custodial or non-custodial exchanges, you see there's a lot of trading on days of max fear. And so a lot of rewards are distributed to DEX token holders on that day because there was an external event, fear, that drove people to trade. What are the correlations with external markets that benefit the interest rate that you were just talking about?
Yeah, for interest rates, it's driven by, in crypto, by far speculation. So when people expect the prices to go up in particular, this causes people to borrow as much money as possible and buy more of the token to get leverage. So we're lending this leverage. And so there's a finite amount of stablecoins in this DeFi, like, it's on the order of a couple tens of billions that are actively sitting in these yield-bearing products. That's a finite amount of capital. If somebody's only so much can be borrowed by people on centralized exchanges and in DeFi lending and stuff like that. So eventually it just runs out. And so once it starts approaching this running out, that's what you see as rising interest rates. The rates have to go up to kind of cool down the market because you can't run out entirely or else you get depegs and stuff like that. So to keep the whole system safe, you have to raise the interest rates to curb the excess behavior, basically. And this is true for like everywhere, basically. This is like banks do this.
Were there any kind of like valuable lessons learned or any interesting perspectives that you were able to glean from how crypto markets and borrow lend markets reacted to the recent hyper downfall that we saw as a result of President Trump's tariffs? We saw like massive market dumps. This was one of those times in the blockchain space where we really see if your code operates as it's supposed to. So were there any interesting insights that you and your team were able to glean as a result of like this peer peak FUD moment that we saw in Q2 of 2025?
At this point, it's actually pretty routine. Like we've gone through this, I would say actually the most extreme event we went through was the Terra Luna depeg. Because there was, at the time, DAI was about 10 billion market cap, and it was like 2 billion, like about 20% of the deposits were wiped out. It was perfect. The protocol even behaved perfectly fine then. So yeah, we've been through many of these really, really sort of peak fear events. But like at this point, I think like especially like CDP lending, there's actually been no bad debt, like all the many years of operating. It's probably like one of the safest ways to get access to crypto speculation leverage yield. It's just tried and true. And so at this point, we watch things all the time, of course, but it's routine in crypto at this stage, I would say.
Maker was probably like one of the first, or I guess maybe like one of the first projects that people who operate in borrow lend and in real world traditional institutions, this was one of the first times that we saw like a real use case for why blockchain, why leverage open source code. And it's because we can do borrow lend according to math. We have this problem in the crypto space where old things aren't shiny and sexy anymore and they lose market attention. And so this was always my thought process into why MakerDAO rebranded into Sky. Where am I wrong? There's got to be more for the rebrand other than we're going to slap a new shiny sticker on something that's been working for years. What was the purpose of changing the identity of one of like the longest running, most real world usable on-chain apps, basically?
So the reason for the rebrand primarily is I know everybody in DeFi loves the DAI brand and they're all used to it. But it was sort of a decision that needs to be made for, like, we're looking at onboarding the next 10, 100x people into the space, where to position yourself. And so not having USD in the name is just like an impediment. It's like this extra hurdle. You kind of have to explain things to people. So from a product perspective, it's much, much easier to just the third largest stablecoin. And so you've got USDT, USDC, USDS, right? You know what it is. It's very straightforward of what it is, even without having to mention beyond that. Yeah, that was the main reason why, in my mind, the rebrand was important, was preparing for the next phase of growth. So it's a little bit of short-term pain for long-term gain.
Have you seen uptick in, I guess, interest from new retail or institutional users post-rebrand?
Yes. So you can look at where we're coming from is we want transparency is the new thing that blockchains can deliver when you're investing in a product. This dashboard that we put out, the data.spark.fi, you can literally see every single dollar where it is deployed across DeFi. So this is already a big advantage I think we have over like more traditional finance type venues. So in terms of growth, like as part of the stats, we track what the number of deposits are. And there's been great growth over the past few months. The supply stands at about $7 billion right now, still maintaining our position as the third largest stablecoin. But on the lending side, actually, we've seen a lot of very exciting interest. Institutions finally really want to dive in on the on-chain stuff. And so I've just been having conversations with lots of big names. They're ready to come on chain, and we're on chain native. We want to stay away from TradFi stuff as much as possible. Well, we do want to cater to these venues. If people want to use their own custodian off chain, that's fine. I don't think that's a problem. As I mentioned, the CDP system, the over collateralized lending on chain, this is one of the most robust systems. The fact that you can do instant liquidations, it just gives you so much more certainty. This combined with the transparency this is what like a stable coin is, right? It's first and foremost, you need to have trust that it's going to hold its value. And so USDS is the best positioned here in my view, in that it's the oldest protocol. The balance sheet is on chain entirely now. Maybe it's not for everybody, but we just want to build the best risk adjusted yield within DeFi.
I do want to give you and your team a shout out to the data dashboard. It's super clean, super sleek. It's phenomenal to see the different partners that you're working with, an easy dashboard to capture total revenue and projected annual revenue. And then you also have at the very bottom of the Spark Liquidity Layer an activity section. And for anybody who's ever used GitHub, it looks very similar. It's like a heat map that's dedicated to the amount of activity that has been seen. And basically since June of last year, it's just been getting hotter and hotter with more and more events taking place on days. So what are these events on the little activity subsection of the dashboard? What classifies as something that gets added to this heat map?
So what you're viewing as an event is the system is automated. It's plugged into Sparkland, Aave, Morpho, Fluid. And so each of these markets has multi-chain as well. So we're on Ethereum, Base, Arbitrum, just recently launched Optimism and Unichain. So the idea is that we just plug this into all the markets and it just sits there and watches the rates. If somebody borrows on this market, we just automatically move more capital in. So effectively, the way to think about this is solving multi-chain and multi-lending market liquidity fragmentation within the space, which is going to be super important because this is one of the big issues, especially with Ethereum and the L2 roadmap. I mean, it's great for scalability, but then you have this trade-off with liquidity fragmentation. So for as much as the capacity of the balance sheet that we have access to, we're actually able to smooth over this issue so that if you are on Arbitrum, you want to borrow $100 million, that's perfectly fine. You can go ahead and do that. And then the Spark Liquidity Layer will fill that capacity in. So, or do it on Base, do the same thing, different assets. So this is the idea here.
What does the world look like then when we have multiple VMs that are being leveraged, maybe like Move VM, Solana VM, in addition to EVM? Because the chains you just mentioned are composable, like Base, Unichain, Arbitrum, they're all EVM. You mentioned that you work on the Ethereum and the EVM portion of Spark, but you also have a portion of the team that's dedicated to the Solana ecosystem. So I'm sure there's a part of the roadmap that has multi-VM support. So what does that world look like? How far away are we from, if I don't want to borrow $100 million on Arbitrum, what if I want to do it on Solana? How far away are we from Spark being the solution for this multi-chain, multi-VM need?
For sure. So we're actively looking at this under Spark, but also, as I mentioned, there could be other stars, sub-DAOs that are focused on some specialization. So our team is not particularly tooled up for the Solana ecosystem, but it doesn't mean that market shouldn't be served. So similar systems will be deployed as well within the Solana ecosystem with a team that is expert in that field, under a different star, so that Sky as a whole, USDS, you provide this similar experience where people can just come deposit it into the yield-bearing USDS. The complexities of DeFi are just completely taken away, and you just can be confident that you're earning the best possible risk-adjusted yield, whether you want to be on Solana or one of these newer chains.
I think as a user, especially someone who's new to DeFi, it can be very confusing and scary, especially when you start looking at, this isn't what's in Spark's purview, liquidity pools. You have these LP tokens and multiple tokens and impermanent loss. And one of the issues is that it's really easy to get wrecked learning how to use these tools. And so something that I found really interesting about the Spark platform is that you have this sandbox where users can play in it before they actually start going on mainnet and borrow lending their assets. So What is the Sandbox? What was the impetus for the tool? And are there any success stories that you've seen from users who maybe made a mistake in the Sandbox before they actually deployed it on mainnet?
It's important that we're dealing with like real people's money here. What we wanted to go for with the Spark app is not like some marvel of engineering complexity. We can distill DeFi into like these core components that it just make it as simple as possible to use. So the savings product is designed to be exactly that. You have some USDC in your wallet, you have some USDT, you have some USDS. Like I think people are familiar with this. And then they just want to get a yield on it. So you just go to Spark Savings and then you try it. But at the same time, people don't necessarily want to be throwing around large chunks of money into something that like they're just trying for the first time. So we provide the Sandbox tool such that we just give $10,000 of every token basically, and then you could just mess around on the interface as much as you want to. And so this is just to get a feel for how this stuff works so you can get more comfortable with it. But first and foremost, the website is designed to be the make it as simple as possible so you basically can't injure yourself in DeFi.
What's the process like then for getting user feedback? When there's a token that's a volatile price, you usually hear people in your corner when number goes up and you hear the salt boys when number goes down. But because you're operating in stable-ish realm, you probably don't necessarily get these super impassioned takes or people reaching out to you on crypto Twitter. What's like the process for the Spark team then for communicating with the users? What is user feedback like?
It's usually quite good, actually. Like such as yourself, I think the team does a really good job. And so usually the feedback is quite positive when I hear it. I mean, we do get complaints with various things. And so there's feedback mechanisms on Discord and such. And so the team is made aware of this stuff. And, we try to improve where the rough edges are as much as we can. But like, as you said, compared to something like Uniswap or other DEX, I'm sure they get all complaints about like, I had huge slippage and I lost my money. And this is just fundamentally a different product. We're trying to be very boring. It's your cash and then you can earn a yield on it and then you can go pay people and stuff like that. Like it's just meant to be like very basic stuff. But we want to be like the front page of DeFi where it's that simple by design. We don't want to be how to do 10x leverage with this like complex thing. Like, no. Just there's a place to park your funds and then you can use them when you want to. That's sort of what we're going for with the website.
Do you have a sense of your user profiles? Because I've always thought that the way I can onboard my dad, who thinks that just blockchain and crypto is a scam in general, is to show him that he can get better yield on his parked capital, maybe through an on-chain solution. And so we're seeing number go up and to the right with the amount of TVL and the amount of revenue and the amount of different partners that Spark has. Are you able to get a sense of who these users are? Because one of the problems we have building on-chain solutions is that we don't collect KYC and we don't have population profiles to know what age groups are participating and using our platforms and our apps and our dApps. So have you guys been able to create a unique solution to figure out who your users are and how to capture different markets to bring them on-chain?
As you say, like DeFi is fundamentally anonymous. I mean, you can kind of do some amount of tracking, but we're looking at like the different types of users. So your dad, such as you said, like maybe doesn't want to use deep DeFi, and that's okay. We want to be able to provide the tools such that people can get access to the yields within DeFi, especially during bull markets, because we think this is a very good product that I think people in TradFi will want. So we look at it like there's three rings. There's the DeFi native population, and I think most people are pretty aware of SUSDS in that space. We go a bit further out into more of this DeFi mullet style where you have some centralized app or exchange or something like that, and we want to provide them the backend infrastructure such that they can plug their users in. If their stablecoins on their platform can just plug in to DeFi in that sense. And so I've seen some awesome, I think there's been a lot of progress in that recently. I think earlier this year, Coinbase launched their Bitcoin Borrow product. I mean, this is not users lending their stablecoins, it's the reverse, but it's still the same sort of style where it's like a DeFi mullet, where people can be on the exchange, they can use Coinbase, they like Coinbase, that's fine. They can take their Bitcoin and then they can take a loan out against it. And then we are actually supplying most of the capital in that market, actually. So Spark is actually 80% of the capital supplied to that Bitcoin Borrow product that Coinbase has launched. And so this style is like kind of more the hybrid in-between stage. We're happy to support that as well. And we've seen a lot of growth there. And then there's the next deep TradFi world. And so we're looking at things like ETFs there, where we have Bitcoin ETF, we have an ETH ETF. There'll probably be like a SOL ETF, I assume. But I think yield-bearing stablecoins is like a next natural fit ETF where we can export this in a package that people prefer, in their 401ks, stuff like that. We want to really just meet the market where it is. I think this will be incredibly compelling product for those who don't necessarily want to speculate on the price of Bitcoin, but they want to, get a good yield. They're on fixed income, pension funds. These types of individuals may want some exposure to what is pretty good and pretty safe yield that comes out of DeFi during bull market conditions in particular.
If you look at the recent shakeup at the Ethereum Foundation, there were 2 new co-executive directors that were brought on, and they're very product focused now. And a team that emerged as part of that shakeup was Etherealized, which is like this Wall Street branch that's going out to traditional institutions and evangelizing as to why they should build institutional products, tokenized products on top of Ethereum. Do you guys have a similar branch, or is there a star perhaps that was launched in order to be this TradFi evangelization team? Or is that just like not in the purview of the Sky umbrella?
No, we're definitely focused on this. So at Phoenix Labs and under Spark, we're definitely talking to a lot of the major institutions and actively looking for doing things such as the ETF. It's still kind of early stages with something like the ETF, but institutional adoption, I think it's really shifting a lot. We've seen like a lot of interest there. So my team is doing that, and the other teams will do it as well. So like the stars, maybe there can be one that's like focused on that, but the stars in and of themselves are going to do this type of business development, like all of them in parallel.
Cool. So when you're out talking to institutions, it's easy to kind of like espouse the merits of getting interest on your stables, but what is like their level of interest in the Spark token? And maybe we can also just use this as an opportunity to talk about what the Spark token is and what its role is within the Spark protocol umbrella.
So the Spark token will be launching soon. We've had great success so far. We've been running a pre-farming campaign on Sparkland for a while. Pendle just launched a program a few weeks ago with PT USDS for Spark points. We've just seen a lot of engagement in the Spark ecosystem. So when the token launches, users are going to be able to stake it, and it will also give governance rights in the future as well.
There's a lot of activity, actually. And so we're currently in Sparkland Season 2, which launched 2.5 weeks ago. So what are these Sparkland seasons? From the outside looking in, they seem to be user-driven, organic social media pushes.
So the Sparkland campaign has been running for a little while. That's the older one. But there's been newer campaigns such as the Pendle one, which was launched recently. And yeah, there's been a lot of excitement for this on Twitter. Yeah, we see just a lot of uptick. We're getting close, and we're very excited to have this out there and have both the OGs who have been with us since the beginning, as well as this whole new batch of people who have come in. And we're just happy to get this thing launched and really get the SubDAO star model live in production and scale this whole decentralized governance thing.
If you had to anticipate governance, I don't want to call them issues, but governance proposals that Spark token holders might participate in, how do you view future governance within the Spark protocol?
These are still being worked under, and so Spark has this relation with Sky in the exchange for the privileged access to the credit line. Spark has to operate within the rules that Sky sets out. So there's this whole, it's called the Atlas, that defines, you could do lending to this, and this is like kind of the risk framework involved with that, but it also will apply to governance. So this TBD, but there also needs to be like some distribution of the token first. So like it'll come, but it's like still being worked on.
Is the whole Spark token then going to be a fair drop where only Sparkland participants, Aave participants are able to gain access to this? Or is there also going to be pre-mine? Like, are you and your team also competing for the Spark tokens with the open and free market?
This is the very unique thing about the Spark token launch, is that there's no VC investment or anything like that. There's no giant unlock overhangs. 65% of the supply is going out as farms. It's public access. So you can deposit your USDS or your Sky tokens, and then you receive SBK tokens in the farm. So in this sense, it looks a lot more like a fair launch token. There's like no insiders or anything like that. There is a team allocation, but it's the vast majority is going out in these farms. So we're very excited. I think it's kind of a different meta than what we've seen before with these large supply unlocks after a year. I think this will be very interesting, and I think it will align the community a lot more with the long-term vision of Spark.
When we look at Spark Lend, there's various different assets that users can borrow against. And there's multiple derivatives of stablecoins and of Ethereum and Bitcoin as well. So can you just share a little bit about how your team went about choosing the various different derivatives of ETH, like WeETH, RETH, and the various different derivatives of Bitcoin, like CBBTC and LBTC, and why you chose them and maybe not some other wrapped protocols?
Maker is a pioneer in the collateral onboarding process in general. We have a risk team called Block Analytica that's been doing this since DeFi existed, basically. And there's a lot of criteria that goes into making a decision about whether to onboard a collateral or not. But first and foremost, it's going to come down to metrics. Is there a large amount of TVL in the project? Is there good liquidity on secondary markets? These types of evaluations. And then you get a ballpark figure for how much loans this will generate. If you feel it's met some sort of threshold, then you can start doing deeper due diligence, like evaluating the team, track record, Lindy, as well as like the smart contract complexity, things like admin access. Is the governance process around the protocol using best practices? This is an incredibly complex process, and it's similar with any sort of credit that you're underwriting in DeFi or TradFi. It's just kind of like different things you need to be focused on in DeFi, such as, there's no smart contracts in TradFi, but counterparty and credit risk are very real things. So it's just risk analysis. It's been done for a while. And in terms of DeFi, our team is one of the best in the space.
So as we're zooming out and wrapping up our time, I'm just curious to hear how Spark views the EVM and L2 landscape. Like, what's your process for choosing which chain to support? Maybe Ethereum is easy to support because it has a large amount of TVL. Maybe Base is really easy to support because that's had the most rampant growth in the past year and a half. But what was the team's thought process on onboarding support for Arbitrum, Optimism, Unichain, and how do you look at other L2s that you want to integrate support for?
It's kind of similar to the collateral onboarding process. We're just looking at user metrics. We're even really deciding. It's more like, there is a decision there. We're just going where the users are. And that's kind of our ethos is like, we're not picking winners and losers. We watch what the market decides is popular chain. And so we just want to serve the users that want to use Spark as a whole. So if we see a lot of people on Base, this is where we'll expand the Spark Liquidity Layer to Spark savings and stuff like that. So it's really like that. And as we improve this process, we're going to be able to just cater to more and more chains. So we really want to just be ubiquitous such that in the sense that we're solving liquidity fragmentation, we can start getting away from this select the chain thing in your wallet. And it's like really the whole thing just feels like one cohesive chain, basically all combined.
Yeah, so I'd be remiss if I didn't talk about the kind of perspective issues that the market and that a lot of long-term on-chain users have had towards Ethereum over the past year and a half. And a couple times throughout this conversation, you've mentioned these issues with liquidity fragmentation. So from your perspective, where you stand, how dire was the situation for just Ethereum as a blockchain and as an ecosystem? Was it ever really at risk? How did this L2-centric roadmap hurt Ethereum, or did it not really matter? I'm just curious in general to hear your overall outlook on how we were viewing Ethereum and maybe how that might have changed over the past quarter of this year.
In terms of liquidity fragmentation, I actually don't view this as an issue at all. I think it's kind of a temporary thing. And with Spark Liquidity Layer in particular, we're actually effectively solving this. So we've just scaled this up over the past few months. So now actually, because we've plugged into Aave and Morpho and Spark Lend on all these various markets, as long as you're using one of the major markets, like you can go on Aave on Base, borrow 500 million. You could do that right now and like it will fill it in. So the rates will not be disjoint in that sense. So that I think is kind of just a temporary problem, including, and as well as like solving it at the application layer, the bridging infrastructure is getting a lot better too. So you see things like Superchain, Ag Layer, forgive me, I've forgotten the Arbitrum one name, making improvements on the settlement time of the cross-chain interop is going to be extremely important. And so us as an application layer, any improvement in the bridging infrastructure, we can take advantage of that too. It's just going to continue to compound. Liquidity fragmentation for US dollars in particular, I think the most important asset that's going to be cross-chain, that's not going to be a problem. I don't think at all. And I think actually that's going to be solved like this year, basically. With regards to the foundation pivot, I've been extremely heartened by the change in direction. I think the L2 roadmap has always been correct. I think it's the best way to scale. But it's also, I like the fact that the L1 is not being neglected. I think that was maybe a little bit of a mistake to be like, get off the L1. I view it as like Ethereum and the L2s, in that the L2s will be successful and Ethereum can be successful. I'm a positive sum type guy. I think we're in a very small market right now and there's a lot of room to grow. And so I don't think we need to be going into this zero sum mindset. Like I'm very pro everything. I'm pro, get Ethereum to grow. Let's get Base, Arbitrum to grow. All the other L2s, let's get Solana to grow. I think giving people the tools that they want to use is what this space is all about. And so I'm a user choice maximalist. I think people should be able to use what they want, and we're happy to support them in whatever they choose.
That's a fantastic insight. And I forgot to ask you this earlier when we were on the MakerDAO rebrand, but I've been part of an ecosystem that had to do a token migration. And there's still to this day, even though it's been 2.5 years since users were asked to migrate tokens, there's still people who don't know about that. What was like your insights that you gleaned from users having to migrate DAI to USDS? If you go onto the Spark platform, there's still DAI lending and borrowing and USDS. So are we in a world where there's support for both DAI and USDS, or do we ultimately want to see kind of all DAI tokens migrate to USDS?
Oh, we definitely don't have to have all DAI tokens migrating to USDS. In fact, even in Sparkland, the biggest market is still DAI. I think it, again, maybe this is my personal view, but I think people should be free to use what they want. So if they want to stay on DAI, that's fine. There's no problem with that. So, but really, we're building USDS for the future growth, but it's okay if people want to stick around on DAI. I don't think that's a problem.
Cool. Well, you mentioned a lot of products that just launched by Spark. Is there anything on the roadmap that we haven't really touched upon yet that you want to highlight real quickly?
Yeah, I mean, the main thing is really just getting out onto all the main chains, really just stepping on the gas with the Spark Liquidity Layer. We want to just hook up every single major exchange such that to solve liquidity fragmentation as much as we can. I think we're getting there. We were maybe 20% of the way there a few months ago. I think we're past the 50% mark now. Really just get that last little bit in, and then we can really improve the experience. Being back-end infrastructure, maybe people don't see this stuff as much, but I think we'll be excited when the rates start going up and suddenly, there's not huge rate spikes on different lending market instances. We'll be okay, yes, we've solved the problem. We're helping to grow the pie for everybody in DeFi.
Awesome. Sam, for anyone who listens to this, who do you want to reach out to you, and what's the best way that they can contact you?
Yeah, reach out to me anytime on Twitter. I'm Hexonaut, so Hexonaut. So DM me or reply to me. I usually try to respond to most people, so...
Cool. Well, thank you so much for your time today, Sam. It was fantastic to dig into Spark. Once again, I highly recommend anybody goes to the data dashboard. It's super cool to look around and play around on, and really cool ways to borrow, lend your stablecoins. And if you're interested in stablecoin yield, check out SUSDS. Appreciate your time today, Sam.
Yeah, thanks for having me.
Cheers. Thank you for tuning in to the Smart Economy podcast. To stay in the loop with all of our latest episodes and insights, head over to www.smarteconomypodcast.com. And don't forget to subscribe to our YouTube channel for all of our video content. If you enjoyed today's discussion, please consider showing your support by liking, commenting, and reviewing this episode on your favorite podcasting platform. Your feedback helps us reach more listeners and bring even better content your way. We'd also love to hear from you. So please don't hesitate to drop a comment on Spotify or YouTube to share what topics you'd like us to cover or who you'd like to see as our next guest. And if you or someone you know would make a great guest, please don't hesitate to reach out. We're always on the hunt for fresh voices and new perspectives. For our NEO token holders out there, please consider voting for NEO News today as your council representative. We've proudly been serving the NEO ecosystem since 2017, and we'll continue to do so by putting portions of our council rewards directly back into ecosystem growth initiatives. So, with all of that said, thank you once again for listening to the Smart Economy podcast, and we can't wait to catch you next time.